signal. While the Fed sits around pondering rates, the people inside these companies are making massive moves. Executives at four specific high-yield tech companies are heavily buying up their own stock. And in the finance world, insider buying is widely considered one of the most reliable leading indicators of future performance. I mean, it makes sense. Executives have the absolute clearest view of their own company's prospects. When multiple insiders buy their own stock at the exact same time, especially high-yield dividend stocks, it broadcasts immense confidence in both the income security and the upside potential. It's a huge green flag.
Let's wrap all this up in Section 5, the Contrarian Framework.
All right, we've tracked the $119 billion, we've uncovered the mechanics of the rotation, and now, let's build a practical framework. First things first, here is exactly what you need to avoid so you don't fall into the same traps as the panicking crowd. You've got to stay entirely away from overhyped AI software companies that have zero clear revenue paths. Avoid any stock that is priced for absolute perfection, because let me tell you, in a rotating market, even the slightest miss is going to cause a massive correction. And finally, please stop momentum chasing at all-time highs. The money has already moved on from the peak of the hype cycle. Conversely, here is what you should be deeply considering: the actual destinations of that $119.2 billion. Look at the picks and shovels, AI infrastructure, and essential commodities like tin. Check out that completely ignored 8.7% dividend tech yielding massive cash flow. Definitely do your homework on those artificially cheap corporate spin-offs with the strong fundamentals, and track the companies exhibiting heavy insider buying. Also, you might want to consider selective gold hedges for some stability. But listen to the warning from our sources here. Be very careful. Some gold funds look like bargains right now, but they are actually just value traps. You've got to be highly selective. To wrap up our explainer today, I want to leave you with this final, genuinely brilliant thought from Forbes, which just perfectly encapsulates everything we've talked about. They ask, the most important question in investing: who has to sell? Think about it. Forced selling, whether it's index funds mechanically rebalancing spin-offs or panicked retail traders just getting forced out of their positions, that is what creates the absolute best market opportunities. Smart money steps in exactly when others are forced to step out. The tech boom isn't ending, folks. It's just rotating. It's rotating from hype to fundamentals. So the real question is, as this historic rotation continues to unfold right in front of us, which side of the trade are you going to be on?